Hi everyone. I think I'm going to start now. We've got just past the hour, so I'll go. Right. Hi, my name is Richard Perry. I am the market analyst at Handtech Markets. This is my webinar, which is the final webinar in my sort of 4 webinar series of called Tips to Save You Pips. It's basically just drags together all my experience really of what I've picked up over the years. And first of all, I'd like to just apologise. Obviously, this webinar was scheduled for Monday, but I wasn't very well, so I had to postpone it. And I apologise if that sort of put you out on Monday, but hopefully it hasn't disturbed you too much. And thank you very much for coming on to today. Right, so just to check, everyone can see my screen, see the slides, and we're good to go. Right, fine. Yeah, so this webinar is basically just the culmination of what I've been talking about over the past few weeks, really, and just gives you a bit of a summary and just a few more ideas that you should really be thinking about when you're getting going on your trading, when you're thinking about what you're doing. In order to sort of try and prevent you making a lot of the really important mistakes that a lot of novice and beginner traders make, which can be costly and can also sort of really impact on your trading account. So that's what I'm going to get going at today. So it's going to be around about, let me just start then. So, always does that annoyingly. Right, okay, first of all, the disclaimer, because I'm going to be talking about live market information, I always have to give you the disclaimer. I'm not going to read all of it because it's quite long and quite dull, but there it is on the screen, and I will show it to you again at the end just in case you haven't had a chance to read it. But there it is. My biography: I've been in the market for 14 years, doing FX and equities and basically just general market analysis really, and I use technicals and fundamentals to do my views, and I'm on CNBC, Reuters, Market Watch, Tip TV, things like that, so I am there to be seen. Right, my agenda for today now, it's going to sort of cover 12 tips really, but across 6 sort of topic areas, I suppose you'd say. Couple of tips on how to start out, and then couple of tips on keeping your feet on the ground, tips on risk management as well, which I think is very important, and then the generation of trading ideas. Obviously, that's one of the main things you're going to be looking at doing, is what you're going to be trading. Technical analysis is a hot topic, and a lot of traders use technical analysis, so which is again what I use as well. So my top tips in technical analysis, and then finally just keeping yourself aware of what is going on in the markets, which is obviously very important. Then after that, I'm going to do about hopefully about 15-20 minutes of live market analysis to get you up to speed with what exactly is going on, and at that stage you can ask me whatever you want. I will try and get to all your questions and answer any analysis questions as well, and anything you want me to look at for you. Right, so I'll get into it quite quickly. Now, I've talked previously about trading strategies and understanding things like emotion trading and how trade management can benefit your account. But this is going to just finish with just these 12 tips that I'm going to be looking at. And first of all, the thing I wanted to say is, when you're starting out, first thing you need to understand is you're not alone out there. Your broker, I would say your broker is a very important resource to use when you're starting out. You need to use them as your sounding board, really, as a discussion over your trading strategy. They are professionals, or hopefully they are, if you choose the right ones. So they should be able to help you out in terms of generating your trading strategy, and it will allow you to sort of make yourself sort of a bit more assured that you're on the right track. I think social media is a very underrated tool in trading. Lots and lots of good people on Twitter, for example. I'm quite active on Twitter. I'm not saying that I'm one of the good ones, but hopefully I like to think I am. But there are a lot of good people to follow out there. I would get on Twitter and really follow some of the big traders out there. because they've got a lot of good knowledge and can give you some good pointers in terms of what you should be looking at. And also trading knowledge in terms of what's going on in the markets as well. Is a very useful tool. And obviously using trading sites and forums such as, obviously we're on FX Street today, use sites like FX Street, because there is a lot of good analysts go on there and give their ideas, and you can just go through them, and certainly that will help you, I think. But then I suppose I would also say don't try and run before you can walk, really. Basically, what I would say is backtest your ideas if you can. But if you're unable to do this, basically trade on a demo account and try and persuade your broker, if possible, to trade on your demo account for as long as you can. Even if you end up trading live as well, maybe run your demo account alongside your live account. I would say trading on a demo account, first of all, is very important because it makes you sort of play around with exactly how the platform works. And it does give you a synthetic view on the market, but you can test out your trading strategy in the safe knowledge that you're not going to be sort of blowing yourself out of the water. So I would certainly do that. And I think that when you're comfortable and you've tested out the demo account enough, then I would say play live in the market with maybe a small amount. Just test the water, dip your toe into because trading live in the market is a different, whole different ball game to trading on a demo account. Gives you an entirely different set of emotions, and I would say that if you sort of start in very small size and know that you're not going to risk too much if you sort of make a wrong move here or there, and that will give you an idea of exactly how the emotions can affect you in your trading. Now, on MT4, for example, which is the platform that I use at Handtech Markets, the smallest trade size you can use is 1 microlot, which is a risk of about, say, for example, on Eurodollar, 10 cents per pip. So even if you're looking for a stop loss of 50 pips, you're only going to lose $5 on one trade. So $5 on one trade with a stop loss of 50 pips, which is actually quite a wide stop loss, actually, when you think about it, especially if you're trading near term anyway. I think that is it's a pretty decent way of looking at the markets. But once you do get comfortable, then you can start to increase your exposure, and you can sort of, as I said, start off in a small size and work your way up, and then you can sort of get an idea of exactly what your level of risk you're comfortable with when you're trading. And I think working your way up to that level is a better way than just sort of blindly just saying, right, well, I'll risk this, that, or the other in my trading, and not actually realize how that affects you when you're trading, because that is a big factor as well. Right. Number 3, give yourself a target. Now, I think it's a little bit of a controversial one, because I think it depends on what sort of trader you are, and it can sort of differ from trader to trader, really, as to exactly whether this is a good idea or not. But I would say that a lot of traders that I know will use personal targets, and they'll stick to them. They'll sort of set themselves maybe a weekly target that they'll work towards, and once they hit that target, they'll sort of close down for the week. Basically, what you're trying to do is you're trying to get out of the mindset of always being in the market, really. And I think that if you set yourself, say, for example, a fixed number of pips or a fixed monetary amount, you can sort of start to be a little bit more regulated in your trading. And but that doesn't necessarily mean that if you go over your target, you shouldn't necessarily have and if you go over your target and you see a perfect trading setup, you shouldn't necessarily trade it. What I would say is, if you have hit your target and you do see that setup that you think, wow, that's a really strong setup, then maybe trade in a smaller size. Basically, you're trying to get away from the whole fact that if that trade does go wrong and you then start losing money and you basically go back below your trading target, that would mentally not be great, I think, for you. I think that it'd be good to say, right, yes, that week, bang, hit that target and move on. So I would say that basically if you sort of trade it in a reduced target, reduced size, then you can almost have a free trade at it. So that's how I would look at that. Now, with regard to losses, I would say that if, say, for example, if you're in loss for 1 week, maybe carry that over and add that to the target of the next week. But at that stage, if you run then to a second week of losses, I would then sort of cut that and just put that to one side and say, okay, put that down to experience. Because basically you're trying to, again, get out of the whole system of sort of doubling up and rolling over. Basically because it has could potentially have quite a significant impact on your psychology, on your trading psychology, and you sort of get into the realms of running the risk of sort of increasing your leverage to try and claw back that trade, that loss that you've got, and you sort of end up in a deeper and deeper hole. So once you've rolled over 1 week, I would say fine, done, move on, and just sort of put it to one side and then start afresh, start a clean slate. Number 4, keep a trader's diary. I've mentioned this before, and I think this is actually a very important point, because I think you learn a hell of a lot when you trade, and I think if you write down exactly what's been happening, what's been going on in the markets, you can figure out what your recurring mistakes are, and then you can learn how to cope with them and how to deal with them. You can also see what's working for you as well, because I think obviously not only do you learn from your mistakes in your trading, but you want to see why you're going, what's going well for you, because you want to try and repeat it. So if you keep yourself a trading diary, I think that will help to drive that whole aspect of your trading. The other thing is that sort of looking at the market every day can be very exhausting. So if you keep a trading diary, you can start to learn the times of the day at which you feel or you seem to be more productive. Say, for example, I know a lot of traders who are really good trading in the morning, but then when the US markets open, markets can start to trade a little bit more erratically, perhaps, or maybe their trading setups don't necessarily work so well, and then they've sort of started to notice that they're making more losses into the afternoon. So that might give you a clue that perhaps trading just through the European session would be a good idea, or just in the morning, and then maybe using the afternoon, maybe just to run through your ideas and maybe just to tweak a few things here and there, and just to not be live in the market and constantly looking, because it can get quite exhausting, being constantly alert and watching the markets. So maybe that's an idea as well. Right, number 5, know your limitations. Now, again, I've sort of touched upon this before, but you need to make sure that you accept your limitations, and you need to understand that making mistakes will happen in trading. Every trader will go through a bad patch when you're trading every now and again, but the main thing is how you deal with it. If you can deal with your losses in a way that is quite philosophical, then I think that will help your trading, because you need to be able to critically analyze I think your trading decisions, and I think if you can do that, then you will be able to be far more sort of accepting of how your trading's going. And I think that if you can grasp the concept that you will make mistakes, it will prevent you from making mistakes such as being over leveraged, and also taking on too much risk as well. So it's the other aspect of this is being not chasing your luck, and not trying to sort of dig your way out of a hole, because at the end of the day it's just going to get worse and worse and worse probably. So you just need to accept when you're wrong. Just understand that you need to, if your trading day's going badly and you put a couple of trades, maybe 3 trades on that have gone badly, maybe just accept that and just shut down for the day, clear your head. Tomorrow's a new day. I mean, basically it just takes a strong trader to walk away when things are going badly, so rather than try to chase the markets, because that is where you let a bad day get worse, and that is not good for anyone. consider the concept of risk in your trading. Now, I mean, just generally speaking, really. I mean, if you spend your time daydreaming about how you're going to spend your winnings and your profits, it's not necessarily going to mean you're going to be in the correct mindset to be a successful trader, because you need to think long and hard about the risks involved in trading. Now, you need to ask yourself a couple of questions, I would say. What can go wrong with this trade, and how can I manage the risk? And I mean, I've talked about in previous webinars, I've talked about stop losses and helping to manage risk and also downside potential. And a stop loss will give you structure to your trading and help you just to sort of put limits in terms of your downside risk. And I think if you can then use stop losses, and that will help you to instigate your trading plan, and help you to become far more of a disciplined trader, and help to become more capable of sort of coping with the emotional side of trading, which can be quite difficult. Right, getting on to research. Now, this one is do your research. Now, I would say sort of take time to properly think about your trading strategy and your trading trigger signals. If you're a technical analysis trader, think about the indicators that you're going to use. Now, for example, on the educational section on the website in Handtech Markets, in fact, why not show you? You've got down here a load of webinars that I've done actually in the past, and a load of technical analysis indicators. And I would say that, I mean, the list of indicators that I've got, there are 10 of them. These are my 10 favorite indicators, and they're all got webinars and PDF handouts and stuff. Now, I'm not saying you should definitely go and use that, but I'm just saying that the resources are out there for you to get down and really do some analysis and learn the indicators that that are going to work for you. I would say that using a scattergun approach in terms of your analysis is never going to be a good idea. You need to really sort of knuckle down and sort of figure out the analysis indicators that really do suit your trading style. For example, I use price and momentum indicators mainly, but there are so many other different indicators that you can use from. I mean, for example, I don't use GAN theory or Elliott wave or things like that, but I know a lot of traders do use that, and it doesn't necessarily make them wrong. They don't work for me, but that's just my opinion. They might work for you. So do your research and really knuckle down the analysis tools that are going to work for you, and understand how they're going to generate the best trading signals for your strategy. So point number 8: don't get bogged down with over analysis. So I suppose, I mean, we talked previously about over trading, which can be an issue for your trading account, and you need to also go from the other side of that and just be aware not to overthink things too much, because I think you can miss the boat, maybe sort of waiting for that sort of absolute tip-top peak ideal setup, and then you've missed the trade. So just be a little bit, as I've got here, you need to be decisive, so be selective in your resources as well, but be decisive in your trading style as well, and not just constantly get bogged down with the theories of technical analysis, and actually just sort of try and actually put it into practice, because it can be different from the textbook, certainly. There'll be a lot of resources that you can use. I mean, as I said, a lot of websites provide research. I write daily research for Handtech Markets, and I would say that reading research can give you a good perspective on the markets when you're just starting out. Maybe sort of pick yourself a couple of analysts or a couple of resources, couple of guys to follow. I'm not necessarily saying follow me, but just saying sort of try not to get yourself bogged down with too many resources, because they're going to analysis is it's an art form, it's not a science. So you're going to get people bringing different views to the table. I suppose that's what makes a market, but ultimately you could have, if you sort of read far too many people, then they're going to sort of give you a whole range of different views, and ultimately you're going to not know which way to look. So I would say just keep it simple and not read too much. And that's pretty much it. But yeah, analysis doesn't have to be complicated, and just that's my final point on the slide. Right, technical analysis. My top tips. Now, I'm a technical analyst. I've got an STA diploma, so I use technicals for my trading setups. Now, in my experience through the years, obviously there's a lot of technical analysis indicators out there, but the big one, the massive one that you need to follow, in my opinion, if you're going to do anything when you're trading, is use trend analysis. The trend is your friend is the number one technical analysis quote or sort of phrase that you'll hear, I think, banded around the markets, and that is because it is absolutely true. Trend is your friend for a very good reason, because it is true. Markets do move in trends, whether you're looking at a 1 minute or a 1 week chart, and what I would say is the more longer term the trend is, the more likely it is to hold, and the more reliable it will be. So if you can, but the point I'm trying to make is if you can identify the trend in the price, and what you need to do is, once you've identified it, trade with the trend, because as I said, if the trend is your friend, then why would you be trading against that? I would stick with the trend as much as you can. Reversal patterns happen, I think, a lot less frequently than you will come to realize, and trading with the trend is the best way, I think, of being successful in technicals, and trading with that. And I think it's the most safest and most profitable way to trade the market. Furthermore, once you can identify the trend, then a lot of other indicators will run off that. I mean, my indicators, for example, all my price indicators and my momentum indicators, exactly how I read those indicators are basically taken from the trend that the market is in. Because you read indicators in different ways in different markets, whether it's an uptrend, a downtrend, or a sideways trending market, it will be different ways to read that market. So if you can ascertain and determine the trend, then you are a long way towards, in my opinion, you're a long way towards sort of being successful in trading. So trade with the trend. I've also got here point number 10, trade the ideas of highest conviction. If you trade the ideas of that have got highest conviction, then you don't need to trade a lot, because you can pick the ones that are actually going to be working. If you use a scattergun approach, then you're going to, I think, be quite rarely profitable, because a lot of the successful traders you'll come across will just maybe trade a handful of positions each week. So basically, if you can look to use the highest probability of success trades or the setups with the highest probability of success, then I think you're going to be far more in line with sort of being able to be profitable in your trading. I engage my own law of multiple confirmation, I call it. To my trading, I look for trading ideas that are set up across a whole number of indicators. Doesn't have to be perfect, but you're looking for multiple confirmation when you trade, because you'll get an awful lot of false signals in technical analysis and the markets, and especially you'll get false signals when you're trading shorter term. And I think if you can wait for a setup where you've got several indicators all confirming the move, then I think that you're going to be able to trade with much higher conviction in those moves. Okay, and last couple. keep informed and be ready to act I've got here. This is basically where a lot of traders or a lot of technical analysis traders get stuck, I think, in the technical analysis world. They can think that oh, don't worry, the technicals will take care of everything. Yes, in theory. I think in practice, you've got a hell of a lot going on in the markets that will turn trades around in an instant. And I would say that locking yourself in a room with nothing but your charts is not going to be the best recipe for success in trading short term. I think you need to be aware of so many different factors that could potentially affect your trading. Because say for example, a price will make a sharp move, and you need to be able to take a view as to whether this move is sustainable or whether it's likely to retrace. Now, if you're going to do that, I think you need to know why the market has made that move. So I'd say keep your ear to the ground when it comes to news flow. I mean, just up until the last month or so, Greece has been massively impacting the markets. Every time a little bit of news flow came out about Greece, how the negotiations were going, the markets turned on a sixpence. And just because they've supposedly accepted this third bailout doesn't necessarily mean that we're not going to just come back and that whole event will not resurface once again, because it obviously will do at some stage. And even now the negotiations are going on over that third bailout. And so you need to be sort of aware as to exactly what is happening. So that is, I think, very important. Also huge fundamental events as well, like key economic announcements. Today, you didn't have a big turnaround, but you had US advanced GDP came out, and the market fell. I mean, euro dollar fell 30 pips, 40 pips in the wake of that announcement. Now, if you were long on euro dollar, then you need to know that, or if you're trading euro dollar, just prior to that, you need to sort of accept or you need to make allowances for that in your trading, either to close the position, because holding very short-term positions over data releases is a very risky game. It basically becomes a 50-50 game, or you need to have a look at your stop losses as well. So it's something you need to just be aware of. I think that news flow can have a massive impact on your technical analysis trading. And I suppose that pretty much takes me to point number 12, the risks of holding positions over economic announcements. As it says here, take note of the economic calendar. That is one of the key factors, I think, here. If you're trading euro, if you're trading, okay, let's just pick one. If you're trading let's be basic. US dollar. Any US dollar data that comes out at 1:30 in the afternoon, or 3 o'clock in the afternoon, just generally 1:30 and 3 o'clock are the two UK times that the US data will come out. If you're holding dollar positions over those times, you could well be have massive volatility. As I've got in the yellow box at the bottom here. Non-farm payrolls, monetary policy, inflation, growth, PMIs, these are all very high volatility events and can have significant impacts across your charts. And I think that for that being in mind, keeping that in mind, you need to know what's going on. You need to know what's about to be released, and you need to adjust your positions accordingly, because any sort of surprise in the position, in the data release can have a significant impact across markets. And as I said earlier, even if you're only running a small stop loss when you're running into a trading announcement, that basically makes it a 50-50 trade. You could easily be chinged out of that trade if the data surprise goes against you. So it becomes an element of luck, basically, trading over economic announcements. And at the end of the day, if you've got a high conviction trade on, do you want to turn it into a 50-50 trade? So you need, in my opinion, to just accept that trading over economic announcements is a very high volatility driver of markets and can affect your trading. Right, that's all my sort of points that I was going to make in terms of trading. Now, what I was going to do is have a look at the markets and see exactly what's going on. In this period, in this sort of piece, if you've got any sort of markets that you want me to look at, give me a shout, and I will take a look for you. But I'm going to quickly just run through all the forex majors and see what's about there. Euro dollar, yes, I will. I will indeed be looking at euro dollar, and here it is. So yeah, what we have here on euro dollar is, in my opinion, a sell into strength. Euro is a sell into strength. It has been for a while. It continues to flow these have these sequence of lower highs. This is on the daily chart, and you've seen all these sort of selling periods and little rallies. Selling period, little rally. Look at this 144-day moving average being used as the basis of resistance. Yes, you had a slight move above it here, but every other time since then, every other time it's got close to that, it's sold off. And again, it's happened in the last few days. Now that, I think, is very interesting. You did have, up until yesterday, you had the stochastics improving, but they've now rolled over again. MACD lines never really got anywhere, but considering, I think, the fact that euro dollar is sort of fairly range bound, it certainly isn't downtrending sharply. I think that sort of reduces the effectiveness of the MACD lines, but certainly I would say that rallies are a chance to sell, and I think that generally speaking, with this 144-day moving average falling away and providing the resistance, I think that is the case. Now, what we have got here is, I think, the 110.50, which I've used, or I've spoken about previously, as I think a big pivot level over the last 6 months or so. 110.50 has been time and time again used as a pivot level. I think the fact that I'm sort of taking that as a bit of a watershed, really. I think the fact that when the euro is trading below that, it's basically is a more negative outlook, and the fact that this rally sort of got just a little bit above it, not too much. I mean, 80 ticks, I think it was, but then fell away again. Never really got clear of it. I think that just shows that the euro is still in a negative mindset and a sell into strength. Now, this is the hourly chart. We did have what was a rally, a pretty decent uptrend actually on the euro, but that's obviously now rolled over. And what we have seen also today is the fact that the euro has again fallen back below the 23.6% fib of this selling pressure, of this original July sell-off, of the last sell-off that we had. 23.6% fib was an interesting sort of basis of consolidation. Held a bit this morning, but then bang, we've seen that decline and fall away. 930, I think that is. Yeah, 109.30 is the reaction low that we saw on the 24th. So that being broken today reopens that 108.70 low, and I think ultimately it just looks like rallies are a chance to sell now. So anything I think you get in terms of a rally on euro, I think is a selling opportunity. There's, again, here's another old resistance became new support, but I think that is now again new resistance. So I think new resistance coming in around that 110.20 mark. So if you did see maybe a rally, I mean, yes, sort of 100 ticks away from where we are now, but if you saw that rally coming through, I think it's a chance to sell. I think also you've got very near-term resistance coming in around that 109.84, but also that fib level as well, 109.56. But I think rallies are a chance to sell on euro dollar, and it certainly looks like it's going lower. So let's look at cable. Oh no, why has that done that? Let's try that again. GBP equals. Cable is an interesting monster because it doesn't really do a lot, and certainly hasn't done much for the past two and a half weeks. Now, the reason I think that is the case, I did some a look at how the forex majors have moved in the last month. Pretty much all of them apart from sterling dollar, pretty much all of them are around about between 3 and 5% lower against the dollar. So the dollar is obviously the dominant currency, and I think that's because we're now seeing interest rate differentials back in play. Now Greece has sort of been near term anyway, resolved. And with interest rate differentials being the key driver of markets, I think that cable is going to be very choppy, and the charts I think are showing that. Looking at these momentum indicators, pretty much neutral. There's a very slight positive outlook on the stochastics, and as I've drawn in here, you've got this uptrend in the past 3-4 months. So cable did try and break out yesterday, and then just came back on the FOMC meeting, but it is sort of still trading arguably range bound, as you can see here, in the last sort of couple of weeks. Really nothing too significant doing. I think the fib levels are very interesting on this chart, actually. Fibonacci of the big decline. Let me just see that, show you. Fibonacci levels of that big decline, those retracement levels are still, I think, only 38.2% seems to be a very, or seems to previously have been a very interesting turnaround point. So that, and again, here we go, 50% coming in and hitting that rebound. So I think when you do move through that fib level 56.30 area, I think you could well see a move up towards that 57 area, which is the 61.8% fib level. So it could well see that cable is starting to push higher. Now I've literally just seen actually, as we're talking, this sort of possible top neckline here, head and shoulders top. So if we do break below that, that comes in around 55.90 area, not too far away, about 10 pips away. So here we go, actually looking at this RSI, hourly RSI has fallen away. So this is me just thinking about it as I'm doing it, really. 4 days worth of hourly RSI finding support around that 40 level. So if you started to see the hourly RSI into the 30s, then also the MACD lines maybe into negative. Last couple of hours we've seen this cable chart coming under pressure, so maybe this is turning into a top pattern. So if that were to be the case, you'd measure that. So that's 56.90 back to 55.90, so that's 100 pips, and then that you'd project that downwards, so that's 54.90, 100 pips of downside if you started to see the hourly chart trading sort of in the 80s, in the 70s, and that if that were to be confirmed by the hourly RSI in the 30s, MACD in the negative territory, then you could well see a bit of a corrective trade going on there. So maybe one to watch. But certainly, I think cable is going to continue to be choppy in the months ahead, and without any real sort of trend direction. Oh, it's happened again. That is annoying. Sorry, just taking a drink there. Right, so what you have seen is, again, a very slight attempt to break out. 24.58, 24.48 was that high back in the 21st of July. And it's just tried to break out today on that GDP data, I'd imagine. Yes, on that GDP data, but not quite making it yet. Now, this is what I'm looking for on here is the RSI again on the daily chart. RSI, if that can move above 60. Look how many times RSI has failed around 60 in the last couple of months. It's never got above 60. Stochastics are still pretty positive though, and MACD lines are okay. But if you started to see the RSI holding above 60, if, say for example on a breakout today and it closed tonight, RSI above 60, and you saw that moving above 24.50, I think that that would be sort of showing that the dollar yen is breaking out again. So we're on the brink, but it's not done it yet because this has been a resistance that has been in place for some time. Yes, it's not quite done it yet. Interestingly enough, we're seeing the hourly RSI pushing above 70, and if that can hold the move, again, that would look as though that the bulls are gaining control. But at the moment, it's not quite doing it yet. Still needs to do it. Right, hold on one sec. FX Boyke saying indicators reflect prices, so are they necessary? That's a question. That's a pretty good question, actually, and one at which I would say get the most amount of information you can out of your charts available. Just by looking at the price action, you do get an overall view, but I would say your indicators can also give you a very good heads up in terms of where markets are moving. Trading with no indicators when you're just using technicals, I think you've got to be pretty talented to do that. I think you use as much information as you can get your hands on, and that's why I use the law of multiple confirmation by you looking at indicators, momentum price indicators, for example. I think all very important, all have a part to play, and why sort of constrict yourself when you can sort of get more information out of your charts than just purely the price action. So I would use indicators, yes. Right. Oh, sorry. Let's go Aussie. Aussie. How are they doing in the cricket? Not so sure about that. Here we go. That's me zooming out on that. So let's go AUD equals. You have this continued negative impact on this chart. You've got the selling phase. You've got all the moving averages falling away. I've got on here a fib projection, actually, interestingly enough, of that selling phase projected lower from that 78.48 level. Interesting that we've sort of held around this 100% fib projection. I don't necessarily think that means that it's going to stop, but I think that's interesting that we are consolidating. We're still in this bearish phase. There is no sign yet of a turnaround. Let me just get the crosshair. Sort of the old support of this old range here is now becoming the new resistance as well, around that 73.50 mark. And I think that the downside pressure generally on the Aussie is going to be significant. Again, playing the is that cricket 4 down 5 down? If it is, I'm going to be very happy. So don't. Oh my god. Okay, focus, Richard. Anyway, so yeah, basically the Aussie is, I think, just under pressure generally speaking, and I think it's going to be just falling away. The interest rate differentials suggest that I think there is further downside in this move, and if you just, how am I going to do this? And then turn that off. This is no. Sorry, the next real downside move, I think, is if you open it all out. You can see these sort of lows that we got 2008, 2009. I think we're going to be sort of continuing down towards those. I think there is further downside. I think that the Aussie just remains under real pressure. And it looks pretty bearish, but yeah, I think it's got further to go. Now on the hourly chart, you can see here what I was saying about the old resistance becoming new support. So the old floor around 73.50 becomes the new resistance, and also the resistance of this downtrend as well. So you've got several things factoring that. I mean, even today, again, you've been putting pressure on these lows again, 72.50 area. I think if you saw a breakdown below that, you're sort of going back towards 70 figure and beyond. So it certainly looks as though the Aussie remains under pressure, just like the cricket, eh? Right, Kiwi. Let's do that. Right, Kiwi. Interesting, because Kiwi showed initial sign, wrong way, initial sign of breaking this really, really well-defined downtrend channel. You had a move out of it, and it seemed to be an attempted breakout. But what I was concerned was the fact that it was just still unwinding some of these momentum indicators. There was so much more that had to be done, really, to suggest that the Kiwi was on a sustainable move higher. For example, this key reaction high remained intact, 67.70, really under pressure, and it sort of never really got going, and sort of moving away once again to the downside. And again, you're sort of still on this whole interest rate differential aspect. It seems as, I mean, although the RBNZ, the Reserve Bank of New Zealand, wasn't as dovish as perhaps they could have been last month, we still have the pressure of the milk prices falling away so sharply. I think that's going to sort of just mean that they're going to remain on a loosening path, and that certainly isn't going to help. So I think that the Kiwi has got further downside. Now, you'd be talking about this initial support. What is going on there? Here we go. So let's just zoom in there. Yeah, the initial support becomes all these candle lows. All of these consolidation candles now become the support. So 65.60 area is what you need to look out for as the next breakdown point. We haven't quite hit that yet today, but you've got pretty close to it. Here we go on the hourly chart. You can see that again, that rally is certainly rolled over now. The momentum indicators turning quite sharply lower. So this is your initial line of support that's coming in here on this chart. 65.55, I suppose, on this intraday chart. And it hasn't been broken yet, but look at the momentum indicators, very negative on MACD, RSI as well. Slightly oversold, very near-term RSI, so you might get a little bit of a pop to the upside, but certainly I would say further downside in this Kiwi. All right, let's go CAD. Why not? Why not indeed? Right, yeah, I mean, it's interesting, isn't it? Oh, CAD New Zealand, really? What's that all about? Let me just undo that. That's just what is happening when I do that. Right, that's a bit better. That is right. Right, okay. You can see here this big breakout, this big range that basically we were trading in, 28.30. Well, it was to the pit 33, I think it was. And we've seen that breakout, and we sort of returned to that breakout almost about 25, 30 pips away, but bounced off that breakout level and pushing higher. You see these momentum indicators still pretty bullish. The only thing I would argue here is the stochastics are a little bit corrective, arguably, but I certainly would be looking more at the RSI and the MACD still. MACD slightly crossing over, but I still think that there is this big support at 28.30 that remains intact. I think any sort of little downside pressure into that 28.30, I think it's a chance to buy, because I think there is further upside in this dollar CAD chart, again driven higher by interest rate moves, or that cut by the BAC on the 15th drove that breakout, and I think that there is further in this run. Technically speaking, this is a pretty strong chart. Yes, it's a little bit arguably stretched, but I think that it's still in a positive outlook on the momentum indicators, and I'd still be happy to be bullish on this chart. Here we go on the hourly chart. Certainly a strong run higher today, again driven higher by this GDP data out of the States. the upward revision of Q1 being very important here. And we're back into this resistance now. Look at this resistance here. Time and time again, apart from obviously we had this minor breakout on the 24th, time and time again we have sort of failed up at this resistance. Interesting. So that's obviously a key level that we need to look out for. 30.43. Well, that's where my crosshair is anyway. But if you started to see that CAD above that, I think that would certainly be a bullish move. Now, very near term, again, you've seen the RSI just moving above 70. That is an interesting move because that is more positive than we've seen that RSI for some time. It sort of hits that 70 mark and rolls away. But interesting that we've gone above 70 now. So is that suggesting that the bulls are really beginning to get going now? Could well be. But I would be more interested in sort of buying dips on this now. I think you've got a pretty decent sort of line of support that comes in here. Old resistance became new support on that minor breakout. So what's that? 29.60 on my chart here. So I'd be looking out for that. If you saw a dip back into that sort of range, really. I think that there is further upside in this dollar CAD. Okay, let's look at gold because I probably haven't got too much further to go. Gold obviously has been massive in terms of that breakdown, hasn't it? Please work. Yes. You had just enormous selling pressure through gold in the last, well, what's that? 2 months, really, 3 months, I suppose, if you say the high from May. And it's now consolidating, really. Today was an interesting one, actually, because we had this selling pressure coming through on gold around the open, but it seems to have rebounded again, and I think it is consolidating. I thought that the breakdown below 1088 this morning was sort of indicative of the fact that I think this is a consolidation, and it isn't going to turn out to be a base pattern. I think it is a consolidation. I say base pattern because you've got the prospect of this move above 1105.60, which if that were to be seen, then you could argue that's a base pattern. I would not call that a base pattern, personally. I would say that is just part of this whole consolidation process. I would be definitely looking to sell gold into strength. And the fact is that we've got, again, just these indicators just unwinding, really. Certainly the daily chart is unwinding on the momentum indicators. Just looks utterly just dreadful, doesn't it? And I think over the last few days, or just over a week, I think this is just a consolidation, and anything would be a chance to sell if you got it on a pop to the upside. Now, 1131 would be your ideal long-term sell zone, because that is obviously your massive overhead resistance from that November low, 1131.85. But what I would say is a move to the downside is ultimately going to be seen, because this chart looks terrible now. Exactly where is it going to go? Again, we've got to open it all the way up. We're sort of now looking back at the 2010 low, which was back from February. But my feeling is that I think it's going back to $1,000 ultimately. I'm saying $1,000 because, first of all, it's psychological. Second of all, because it's a big round number. But also the fact that you're round about that, you're seeing that the cost of production levels are being really tested. And yes, you're going to get your higher cost producers dropping out of the market, which will drag down the cost of production. But still, I think I'm not expecting a massive load of downside pressure too much below, not a massive amount below 1,000, and I think 1,000 is pretty reasonable sort of area to start coming back to. Also, you've got, if I sort of come back towards here, $1,000 was a pretty strong resistance back in sort of 2008, 2009. And ultimately, I think that will be again supportive. So $1,000 is what I'm going for on gold. I really apologise to FX Boyke because I haven't got time to do $R. So I really apologise for that. But very quickly, let me just wrap this up. This is very quickly, my market research on our research page is all there. handtechfx.com/market-research. All my research is there. Do daily videos as well, and also my Twitter feed. My Twitter feed is @handtechrich if you want to follow me. A little bit of cricket in there as well. Why not? We're doing quite well. Yes, so I'll talk about markets as well. But at that stage, I will show you my disclaimer again. And thank you very much for listening. And I'm off to celebrate England cricket team. So thanks for listening today, guys. And I will speak to you again next time. Thank you very much.